Now, if you want to get started picking your own stocks, the S&P 500 is a natural place to start. Hello there, welcome to another video on investing in stocks. This time we're going to pick our own stocks. Now, before I begin the video, you can grab one of these t-shirts, link is in the description. So the Standard & Poor's 500, or the S&P 500, is the go-to benchmark for the US stock market. And most of the big well-known companies are in the US and most of them are in the S&P 500. So when you're trying to pick your first stocks, this is a place most people will look. Now, before I begin, I'm excluding my own personal holdings. So no Apple, no Activision Blizzard, Intel Corporation, Jpmorgan, Amazon, Waste Management, none of these. These are stocks that I don't own. I've divided them into growth stocks, which I base on revenue growth year over year. Value stocks, where you get a lot of bang for your buck. So these are companies with a lot of money on the balance sheet and a lot of assets. And then income stocks, which are mostly value stocks, just paying a very high dividend. So we're going to start off with a company we all know and love, Alphabet, aka Google. They have 20% revenue growth year over year, so that's the last 365 days. For such a large company, that's very good, very, very strong. They have $25 billion in free cash flow, so that's all the money they're left with. So Google has more money than they know what to do with. I think they should start paying a dividend. I don't know, you guys think? And obviously they have strong innovation. They keep buying smaller companies, keep getting into more spaces. They are very well diversified. It's almost like a tech index fund. Next up, Boeing. This company and the stock is on fire. I think it's a great investment. Not only do you get a very safe company with $8 billion in free cash flow, $90 billion in assets, so that's like factories and inventory and stuff, but they also pay 2% dividend. So it's not only a good stock, but they still have good growth. They are by far the best company. They have not the strongest competition, so they pretty much only have one competitor in Airbus, which is a strong competitor, but those are pretty much the only ones. Then you have Facebook, another massive growth tech stock. This is such a profitable business. They have 40% revenue growth year over year, crushing Google. $11 billion in free cash flow for such a young company, and they have 45% operating margin. So this is a very profitable business. They don't have to spend a lot of money. They're just making money, then that's it. Also a company that is well diversified. They pretty much dominate the social media space, and I definitely think Facebook can make some acquisitions in the coming years. Federal Realty Investment Trust, this is pretty much a REIT, ticker FRT. It pays 3.26% dividend, massive dividend. So this is a way to actually invest in real estate through this company. It's also a value play, so for those of you looking for dividend, that's a good play. Then we have Gilead Sciences, ticker GILD, which is a biotech stock. So these guys are researching new drugs and treatments for serious diseases and illnesses. They pay 2.6% dividend, so almost an income stock right there. 9 price to earnings ratio. Now, some biotech companies has a really low price to earnings ratio, which means which is the comparison between the stock price and how much the company earns. Now, keep in mind the PE ratio varies from industry to industry. So Boeing, for example, has like a 9 PE as well, while Facebook or Google or PayPal has like 40, 50, 60 PE. But even though a company has low PE doesn't mean it's a value stock, but in this case I think it is. And they have $16 billion in free cash flow. The stock has taken a massive beating, so this is a company you can take a look at. It's risky, but you get such a good dividend, and look at the free cash flow, 16 billion. They have more than Facebook. Most people haven't even heard of Gilead. Then we have General Dynamics, which is like an industrial company. They work on like engines and big boats and machines for the military mostly. Very well diversified company. Just look at this, 33 billion in assets. They have a lot of factories and inventory. 20 PE, quite low, so that's something to look at. Very stable stock. This is just like a Microsoft or Apple. It just slowly continues to go up and up. A stable stock price is quite important to me, you know, because it shows a stable management, and it shows that the company has been able to do well in good and bad times. Johnson&Johnson, we all know it, we all love it. $15 billion in free cash flow, 2.3% dividend, almost qualifies as an income stock, and it has $141 billion in assets. This is pretty much as safe as it gets. They sell every normal medicine and, you know, stuff you buy at the convenience store or whatever. They're global. It's pretty much as safe as it gets. Johnson&Johnson will pretty much just grow together with the economy, and unless the market crashes, this stock is not going anywhere. Now, a very interesting income investment. This is one of Warren Buffett's largest holdings. The Kraft Heinz company makes food products, most notably the ketchup that we all know and love. Heinz is by far the best ketchup. Ketchup goes with anything as well. Not on pizza though. Ketchup on pizza, no, just stop it. Just stop it. Oh, sorry, it's supposed to say 3.14. It's gone. 3.14% dividend, $120 billion in assets, and it's pretty much one of the safest stocks. Like stuff like Johnson&Johnson and Kraft Heinz is just pretty much as safe as it gets, because they sell everyday products that we're gonna need every day. Microsoft, on fire at the moment. Satya Nadella is a great CEO. 1.9% dividend, pretty much 2%. Sorry, some of the text is gone, by the way. 31 billion in free cash flow. That's $31 billion left over. 31 billion, $241 billion in assets. Microsoft, I think, is only beaten by Apple in terms of free cash flow and assets. So again, as safe as it gets, and since it's a tech stock, you do get more growth than with a Johnson&Johnson or a Kraft Heinz. So Microsoft is somewhere in the middle between Google and, you know, Kraft Heinz or something. Bank of America had to have a bank in here. 31% operating margin, very profitable. Only 18 price to earnings. Financials and banks are actually quite low priced now. They haven't done very well since the recession. So this is, besides tech, I think financials is a great sector to go in. Now, I decided to go with Jpmorgan, but there's not much difference between Bank of America and Jpmorgan. And the US economy is kicking ass right now, so the banks are definitely going to do well. $20 billion in free cash flow. I mean, 20 billion. Like they don't even know what to do with all that money. Growth, definitely growth is okay. PayPal, ticker PYPL, 17% growth year over year. Not too impressive, but they had 22% payments growth. So the volume in transactions that PayPal does went up, which is maybe more important than the growth. PayPal is growing faster, spending a lot of money on growth and new partnerships and apps and stuff and new technology. So I think the most important thing for PayPal is how much money they actually that actually goes through the PayPal ecosystem rather than the revenue growth. Because revenue growth is not everything. You know, revenue growth doesn't like necessarily just describe the entire story in terms of growth. Pepsi company, ticker PEP, 2.7% dividend. So this pretty much is an income stock. 25% PE. It might sound high, but Pepsi is doing very well. This is not just the Pepsi soda, it's also like all sorts of chocolate and sweets and like Doritos and stuff. So Pepsi is doing really well. Really great female CEO, $7 billion in free cash flow. This is really safe. I mean, people are always going to drink soda and eat chocolate. They have some healthy stuff as well. 2.7% dividend. You almost can't go wrong with that. Whether you want to go with Coca-Cola or Pepsi, I don't know, but I like Pepsi because they're more diversified into like snacks. And they're more diversified in beverages, I think. The company we all know and love, Disney, ticker DIS. We all love Disney, you know, especially my generation. We grew up with some of the best Disney movies of all time. Wouldn't it be lovely to know that every time you go to the cinema or watch a Disney movie with your kids, you know that you're a part of Disney? I used to be a Disney investor, but I found out that I think I was wrong about the stock, so I don't think it's a great investment. So we have $9 billion in free cash flow, not too impressive, almost $100 billion in assets, you know, theme parks and stuff like that. 19 PE, the stock has done terribly lately. It's gone sideways since 2015, and this is the first time that Disney stock has taken a break since 1930 or 40. This is one of the oldest stocks around. The stock has gone up and up and up, but as I said, this is a good buying opportunity. It has never done this poorly, so get in to Disney if you were looking at the company anyways. And of course they have they have the best intellectual property in the world. Trust me, Disney is pretty much the most powerful thing in the world. No one can do what Disney does, and they have the best movies. There's not even any competition. So if Disney can execute and make sure that they get paid for all their great titles, this could be a sleeping horse, no, a sleeping giant, something like that. So these are my favorite stock of the ones I don't own. Of course, I would prefer all my personal holdings over these. So have a look. You can also check out the Nasdaq, Dow Jones Industrial Average, FTSE 100, the DAX 30, the Hang Seng, the whatever, Tokyo Stock Exchange. But yeah, these are my favorites. Let me know what companies you own in the S&P 500. There's a lot of them. And yeah, good luck.